Right, so what I'm going to do today is take you through workpapers and depreciation. I think we're going to start with depreciation, and the first thing I'm going to do is we're going to have a look at how depreciation is currently implemented in the system. So I've got some dummy entities here, and in that set of dummy entities I've got an individual, and I'll show you now if we've got a tax form, company tax return, individual tax return, and in this tax return, we'll see if we can continue without a TFN. We activate our depreciation, noting that we've got depreciation to activate in the ITR. And we probably need some work-related expenses just to try this. We could try it in the business as well. But wherever in the tax forms you add depreciable assets, so for instance in depreciation, you'll notice we've now got quick adds inside the product. So you can very easily put in your asset, now if it's an older asset 2022, because we're in the 2025 year, then you're going to have some kind of opening written down value, and you'll have to just finish off by putting in the information like that, and then the system will auto calculate the depreciation. So of course if you needed to sell that asset, you'd have to open it up and you would have to put in a sale price on it, right? Or you could change the value of the asset. Now that's tax depreciation, and that tax depreciation methodology carries forward through the whole system, both with respect to business. So in business, you could also come in here and you'd find your depreciation, capital allowance, capital works, and you could put in your asset again here, right? So that's in an individual in the business. Now let's go back to Edwards & Co. Maybe we'll try with number 2. I don't think I've activated depreciation in this entity. No. Well, that's good. So if you're going to use a company where you want to have an external set of accounting-based depreciations, remember you can do the tax depreciation in the form, but what we're now saying is that our external depreciation tool, which is here and the reports here, if you want to use this external tool, external to the form, then by all means use it for calculating accounting-based depreciation. The key with this is that you're going to put in your start date, right? So if you're starting a 2025 tax form, you probably have opening written down values on the 1st of July 2024. So if you're going to use this depreciation module for accounting-based depreciation, you don't need to use this unless you just want to use it for accounting depreciation. So maybe we've got motor vehicles, right? That'll be business. Now these are the different sectors of the tax form where you could have a depreciation module. And this is no longer relevant because, as I said, you're now doing depreciation in the tax form. But how we built the system is we put it together in a way that initially or originally this tool was used for tax depreciation. We didn't have the concept of accounting depreciation. We now have that concept of accounting depreciation, and so if we're going to be using this, you can see I've now got a group. So if we had a look at the groups, that's the group, and this is what the group asset group looks like on the outside. So if we're going to add in an asset, add in your asset, and maybe this is a Corolla. Purchase date 1st of the 8th, 2022. Purchase cost, maybe it's 40,000. You'll notice that we've got the car limits. None of this is relevant anymore in here because you'd use the tax depreciation calculations for tax. This is only if you want to use for accounting. Diminishing value, and maybe the effective life is 8 years. Now you can see if you've already got opening written down values, you'd be putting your opening written down values in here. You wouldn't use the calculation, but for me, I use the calculation because I don't have opening written down values off another schedule. And then I can save that asset in. Now that asset will now sit in that schedule. And if I want to report on it, I use these tools here. So as I said, this external module is ultimately just for accounting-based depreciation. And of course, as I mentioned, the tax depreciation, again, if you're in the tax form, you would use the tax depreciation module for tax calculations. Let's just get this company form loaded. You'll see it's activated the depreciation because it knows there's depreciation outside the form. And this is simply telling you how we're doing it now. It says we're doing tax depreciation in the tax form. Now, how it was previously, you'd have the whole grouped depreciation value reflected there under depreciation F, which also interacts with the reconciliation at F. Moreover, now what we'll do is we'll migrate that accounting-based asset into the form. So you'll see you'll have the option to migrate that asset in, and then you'll actually see the asset now. It's not just the group, it's the actual underlying asset. And if there were 10 assets or 50 assets, they would all come into the tax form and you would have the correct tax values here. Moreover, here you can see in the recon, if there is accounting, now let's just import some accounts so you can see what it will do. Okay, it looks like we've already got some accounting in here, but we don't have depreciation. So I'll take this lot out and we'll start with a fresh set out of Excel. So let's just disconnect that so we don't use QuickBooks anymore. We'll use Excel. And there might have been an Excel in there before, but let's start from scratch.
Yeah.
And I will bring in the schedule that will be relevant for this, because it'll have some depreciation in it. Okay. So we've got our depreciation in here. So this is just some accounting depreciation, and then, you know, if it's mapped to depreciation, is mapped to depreciation for, say, we'll just say motor vehicle depreciation. Okay, it doesn't really matter, but the main thing is that you'll see it now in the form. You'll see how the form behaves, because what it'll do is it will exclude the accounting-based depreciation as less. Sorry, the other way around. Should be the other way around. Where is that? Okay, why don't we see our depreciation? Because we've got 2025 depreciation 1268. We should see that. We should see that there. You know what? Because I've just brought in the values after the form was already loaded, I need to put the form in first. Yeah, I need to start with a new form. And now we should see the, yes, so now we'll have the accounting depreciation, which is here at X, and then that is excluded according to the ATO rules at W as a non-deductible. And then the tax value is brought in as F, which of course we just saw how that works over there. So that's essentially a look at how depreciation works in the system. And of course, for tax depreciation, if you had low value pools, you need to set them up in here, and the same for general pools, etc. So now let's move on from depreciation, because you've got a reasonable idea of depreciation. We'll just go and have a look at the different tools that we have. So we'll start with the franking account, and the share register. So what we have here is we have a share register, and maybe I can set this up from scratch in the other company so you can see how easy this is to set up. We already have a share register here. Let me just remove the classes and the shares so that we can start from scratch, and also take out the dividend. So we should have nothing in here now. Oh, we've got some issued capital. Yep, now we're free of everything. So if you did go to the share register, and let's just actually start the franking account from scratch as well. And we'll even clear out the balance. So essentially what we have now is we need to start with a share register if you want to use this module. Very easy. The first thing is to put in your classes of shares. And always put a very large authorized number, because it'll issue out of that. Okay. So we've got an authorized number. We don't need to worry about these other things. Now we're going to save and issue some shares. So the issue date will be whatever date this was done in the past, right? Maybe these shares were issued back in 2020, and we had a number that would have been issued. We'll say 100 shares were issued, and they would have been issued to someone. Now you can put this in so it's beneficially held or not. Let's put in James. We'll just put in James in his own right. James Henry Doe will hold these shares. So he holds them in his own right. Otherwise, if you untick that, you're going to have to say who the beneficiary is. This will be certificate 1, serial number 1 to 100. And that is essentially us issuing the shares, right? Now, you can assign shares from here if you need to assign some of these shares to someone else later. But now we have James Henry, and we will now be able to manage the dividends. So you can see here's the opening balance, making sure that if you do start with an opening balance on a particular date, so maybe we're starting 2024, if you're coming into the system from another system, and maybe there would have been a balance, let's just say it's 18,000 credits. From here, you can add transactions in here. So you might have payment of tax, whether that's tax credits or whatever, on a certain date. That's one way to do it. You simply add in all your transactions, and of course, when it comes time to paying a dividend, pay the dividend on those shares and whatever the dividend amount is. And maybe this needs to be within that financial year if we want to see it in the tax form. Okay, or maybe it was paid right at the end of June. And maybe that was 50% franked. Now the calculation here will be at 30% because let's just do, you'll see as 50/50 1666, right? Because if you had set this as, oh, it is set as small business. Okay, so let's take that out just to show you what the impact is. Tools. We'll do another dividend on the same day. And that'll also be 50% franked, just so it's exactly the same as our last one. Now, noting how the calculation of the franking credit is different because I untick that box in there, right? I untick the small business entity box. Not totally correct, because really it's base rate entity that changes the tax rate. But needless to say that is the tick box that's important if you want to have these calculating at different rates. Now, that's exactly what's happened, and that's what you will now see in the tax form. You'll see that the dividends paid, and you'll see the franking credits. Now, noting that both of those there were two different dividends paid, both with different amounts, but all of the impact on the franking account will take place through here. This doesn't all get sent to the ATO. The only thing that gets sent to the ATO is the compressed total. So what do I mean by the compressed total? It's just whatever this sort of comes to, like this, right? ATO only gets they only get the P and the M. They don't get the intermediary transaction set. Now, one thing to note with all of this is that when you want to fill the tax values in, it could be the case that it's just easier to fill the franking account from, now this is an actual entity, instead of manually adding the transactions, I can import from the validators. So let's have a look at what's happened through this time frame on the integrated account. We'll search across the top. Actually, we need to load these in, right? So we're going to need to load in the, and we do it here, import integrated account. You need to first import your integrated account. This is importing straight out of the ATO systems. Now you can see that these transactions there, so let's just deal with the 25,000 PAYG installments, or actually there's an 80,000 PAYG installment. If we want to fill the franking account, of course we can manually put them in, but we can import from the validator. So this is the time range. We've got our integrated account, search that, and then we go, well, that's a PAYG installment. That's a payment of tax. You see, and then you can just look down here in payment of tax or a PAYG installment. It's really up to you. It's flexible. So if you prefer to put it in with the actual payment, put it in with the payment, right? You can see that. But I'm just doing it on the installments. It's up to you. But it's an easy way to pick up the values and then just do the import. I'm not working on this job now, but I'm just showing you that's how you can do it. Exactly the same when it comes to tax paid. So ATO account, income tax account validator, import transactions, and same thing again, it's importing from the ATO. So you're bringing those transactions in, and that again will allow you to work with your franking account and import from the validators, but this time the validator that you're going to work with is going to be the income tax validator. Now, no tax paid through that time frame, but let's just expand that out, and you've got payment received, right? So maybe that's your tax, payment of tax, right? And then import. So it gives you the flexibility to import from the ATO and classify the transactions directly out of the ATO integrated and tax account, which of course will save you the hassle of miskeying the values or picking up the wrong values. Of course, you still have to discriminate and decide which values to import.
So the PAYG installments whatsoever being paid, will that be reflecting in the company tax return?
Yes, exactly. Yep. As long as you import them, as you import them into the integrated account.
Okay. Nevertheless, it happens even though we import it or don't report it, because the moment we prefill it, it's the PAYG installments coming up there, despite whether it's paid or not by default.
True. That's why it's up to you to discriminate and decide whether you reflect the payment or the actual PAYG installment value, because you're correct. I mean, it should be done on the payment basis, but you're looking to see. I mean, it depends on what's easiest to look at, which ones you. So you got to choose which ones you're going to bring in. Right?
Will this step add any extra layer saying that has been paid, so or else nevertheless it's coming as it is coming before? as a preferred.
It's coming as it's coming before, whether it's paid or whether it's just the value that's sitting there as the ATO value. It's going to reflect in that. It's going to reflect in the franking
PAYG
account. It's going to
Yeah.
reflect in the franking account.
Oh, yeah. Yeah. So it's only specifically to this working paper?
Yeah, exactly.
Not the tax return.
Well, it will fall into the tax. Whatever shows in here will reflect in. So you can see these values in here. Let's have a look in the tax form. We've only got 3 in there, right?
Yeah.
So yes, it'll whatever comes in that franking account section will then reflect inside of here.
Yeah.
So if we now open this up,
yeah,
franking account, you can see there are the values in here within the date range. Okay. These are the values that are in here. Now, where is the tax paid? Because I thought there was a tax paid. Let's just have a look at that. We've got 1 July to 30 June. And let's have a look at the franking account. Ah, that's why, because it's after the 30th of June. So it's not going to reflect in there. But if we change this, you know, if we put this back there somewhere, now that will then reflect in that tax form. There it is, tax paid. So hopefully that makes sense. Now let's have a look. Okay, so we've had a look at the franking account and the share register. I believe I've got some shares in here. Yep. So this module is really just for tracking buying and selling of shares. And you can see here that we've got some Telstra shares, some Wesfarmers shares, and these would have been bought. You see, there's some buys and sells in here, right? And the thing that makes this work is that you can choose which batch of shares to sell first. So you can see I've got batch of shares bought on 3 different dates. Now, there's still shares left over. Now, if I go to add a transaction for those NAB shares, and I'm going to sell some NAB shares, right? See, I'm looking at NAB shares here. Now, I can now choose which ones I will sell first. I will most likely sell out the ones with a larger cost base first to minimize. So this might be on, again, end of June. Maybe I sell them at the end of June. And you can see here I've got 1,000 left over, so I'm going to sell out 1,000. And the unit price we'll put in as $28. So we're making $10 a share. And now if we look at a report, so that would be a capital gains report. Now we can look at it at an individual level, at the NAB level. So we would be looking at capital gains for NAB. You can see here that there is 2. Okay, so in this time frame, I've sold out 2,000 shares, but they came out of two packages. Moreover, if we have a look at the capital gains summary, let's have a look at the capital gains summary. You can see these are your long-term gains, short-term gains less than 12 months. The long-term gains more than 12 months, the cost base, the sale value, the net capital gain. Now, this does not interact with the tax form. This is really just an external tool that you can choose to use or not if you want to track shares in a LIFO, FIFO kind of basis. That's all it is.
Yeah. Is there any provision for crypto?
You know, crypto is a complex problem space, and there's better tools to use. There's professional tools on the market. I would, you know, if you're serious about crypto calculations, you'd probably use one of those tools. Crypto's a real, this is probably not going to work because crypto can be a lot of transactions. Sorry?
Do you have any suggestions for the external tools?
I've used one. I did some crypto for a while, and I can't even remember the name of the software that I use, but I think it's a case of just do your research,
Okay.
ask Perplexity what's best used for Australia, that kind of, the AI is probably pretty good at giving you
Yeah,
some good
it's better
suggestions
nowadays
these
to
days. Yeah.
Yeah.
So, okay, so let's go. The next thing that we've got is hire purchase tool. The hire purchase tools are very simple to use. I probably don't need to elaborate on this. You can also find more detailed instructions inside. You can attach a copy of the contract, put in your borrowing amount, interest rates, number of payments. You can put in balloons if you have balloons. Always note that the payment type is in arrears or in advance. So you've got to look carefully. And then from that, you will get your amortization table, which, if it's correct, it's going to come close to zero at the end of it all. So you'll know that everything's right. And you'll see that what it does is on the date lines, the financial year date lines, it gives you the total interest and what you'd expect to have in the current and non-current liabilities if you split out your hire purchase in that way, which is that kind of traditional approach to reporting your hire purchases. Now, let's have a look here. I just want to have another look at this hire purchase because I think it's an older one. 2016, yes. So because it's 2016, it's gonna finish a little early, as in not in the current financial year. So April 2021, it's already finished. So let's have a look between 2019 and 2020. If we look at the summary, and we'll see that we've got, okay, I probably need to go even earlier so that we can see 2 years of balances here. So this would be your total 13,034.40 at the end of 2019. That's the total, right? But that's composed of the splits between the current and the non-current. If you're using that traditional approach, 13,034.40 2019. Just to double check that, you can see it here. 2019. Yeah, 1303. It's a couple of cents different, but needless to say, it's pretty close. 1303.390. I think it's a rounding difference. Okay.
Yep.
Probably because it's calculating slightly differently at the end anyway. So that is the toolkit for hire purchase. Borrowing costs, pretty much the same thing. Borrowing costs just amortizing over 5 years. You can have as many of these contracts as you like, and again you'll get a granular look. So whichever borrowing cost, and this is just for some reason all my assets showing in this list here. I don't know why, but if I go back to my borrowing cost, I've got NAB borrowing costs. So let's have a look at that borrowing cost tool. NAB, yeah. So there's your amortization table from that point of view, and then you also get another perspective, which is, again, it's probably quite an old one. You can see here what you'd expect, and if you had a whole lot of these in here, you'd have NAB, CBA, all the borrowing cost or amortizations in the total. So you get two different perspectives on it, same as with the hire purchase. So that pretty much covers off the tools and the reports. And now I think what I can do is, what's the other one that I wanted to show you? I think we're pretty much through, actually. Oh no, there's the only other ones I'd like to show is, let's go and have a look at these tools. So what we have is we have a whole heap of tools for analyzing your GST. And let's have a look. So for Desert Run year to date, you can see that we've got a total which is a few dollars out, because what we're essentially doing is we're comparing what's coming out of the ATO systems. If I open that up, we'll see that we've got this amortization table. Sorry, we've got this GST, PAYG, we've got the activity statement values, which are coming out of this here. So every one of these is really a straight off the
Portal.
activity statement, right?
So
all of
these ones are coming from the portal. Okay.
Well, it's either coming from the portal if your client lodged it, or it's here already here in lodge it if you lodged it. But it's essentially what's in the ATO. So
Okay.
whatever
So
is in
what's
the
in
top,
ATO is what is getting
yeah,
reflected.
this is what's in the ATO, and then this is what's in the accounts.
Okay.
Now, because this is accounting software as QuickBooks, you can actually bring in these values from QuickBooks. Let's just bring these in. I should be able to just bring these in. Okay, so if we're missing values, just import. And you're getting your GST data out of QuickBooks. So it doesn't work like this for any other the other software. The other ones you have to manually key it in. But notice now how it's all filled, and you can see overall we've got $300 difference, and then it's really up to you if you want to open that activity statement for June and do a correction in the June quarter to get that correct, right? You don't have to worry about these capital purchases so much because they're not there in QuickBooks anyway. You don't get the data feed out from, so you can ignore the differences here. That's irrelevant. You're really just looking here, and you can see overall it's pretty close. We've got like a $300 difference for the year. It's almost like, well, will you be bothered to make an amendment? But obviously, if there's a lot of variance, you would. Now, the same thing happens with your payroll. Now, it doesn't look like there's any payroll for this client, but needless to say, it's the same kind of concept. If the client lodged their activity statements, you could load it in from here. So you could say, we'll pull all the activity statements for the 2025 year, and it would pull them all in, and then you would have the values to compare in the payroll activity statement. Right. Now, there isn't any here. Now, again, either if it's QuickBooks, it's going to automatically pull in from the payroll software, and this section here is going to load in from the activity statements, and then you've got your variance and your ability to carry out a comparison. So you can do that with your annual, because some clients lodge annual activity statements. You've got a payroll analyzer, GST analyzer. The pay refund analyzer is for those circumstances where, let's just go to 2023. Okay, pay refund analyzer. Well, it doesn't really matter which year we're in, 2024, 25. This is really just where you can see everything. It's just a different granular look. So maybe I need to load. Oh, 25. Okay, so 2025 pay refund is just everything that's happened through that time frame. And essentially what that is here you can see they've got a fuel tax credit, right? So we're looking at this from the point of view of the GST on sales, GST on purchases. This is not purely for analyzing the GST or the PAYG. It's for analyzing everything. You'd see everything across here. I don't necessarily fill this. I don't necessarily fill it, but I do use it to double check things like fuel tax credits and any of these other tax credits over here, fuel tax credit, overclaims, etc. So that's what this is quite useful for. Okay. And then
So
you've got your...
Sorry to interrupt you. The credits here, will that be populated directly into the tax return?
Okay, that's for the company tax return, right?
Yeah, the company tax return, just.
Yes, there is a button. There is a button in the company tax return. Let's just go
fuel
to
tax
Edwards.
credits here, yeah.
No. Well, not for the fuel tax credits, for the PAYG credits, because if you see down here, you really would want to pre-fill your quarterly activity installments that have been paid, right? And then if you click here, this is not going to work because it's a dummy entity, but then if you did have if it was connected to the ATO, you click here and it'll import the PAYG credits into the tax form.
Fuel tax credits I'm talking about.
Yeah, but where are you going to import? Well, the fuel tax credit, let's just go back to we'll have a look back at Desert Run, and let's just have a look at their, so it's the Pay Refund Analyzer. Yeah, these are just on the activity statement. So if I open that activity statement summary, you can see these are fuel tax credit. That's where it's coming from.
Yeah, okay.
That's all it is. It's just presenting it in a tabular format like that. That's all it's doing. And then, of course, you would double check that you've got the same fuel tax credits in your accounting software for that should be the revenue. That should be a revenue. In the revenue section, you should have 20,774. Now, there's one more thing in here that can be useful, and that is the true balance validator. Now, it's possible. No, actually, there's two more things. The other one is, so let's have a look at the reconciliation analyzer first, and this would have been relevant in the 23 year. So essentially what this is doing is allowing you to select your activity. So this is the activity statement on a cash basis, right? And this is the GST on the activity statement. This is the GST on the purchases, okay, on the activity statement, right? The June activity statement. These are the balances. Moreover, that's not what you should expect to find on the ledger, because of course on the ledger you've also got the GST associated with the debtors, or the accounts receivable, and the creditors, the accounts payable. So really, to see what you should expect to find on the ledger, you would have the GST on the sales and the GST on the purchases added to the activity statement, and then this is what you'd expect to find on the balance sheet, either each of these or just the total, right? That would be what you'd expect to find as the GST, receivable or payable, right? In this case, it's a receivable because it's got a minus sign. So, because of course this is not net GST payable, it's actually the other way around. So that's a debit. But essentially, this is what you'd expect to find on the balance sheet, because of course the GST is included on an accruals basis, and therefore on the balance sheet it'll be there, but this is what will be on the activity statement, because the activity statement is cash, balance sheet is accrual, and therefore you expect to find that these GST components are included. And now how do you get now the question is, how do you get these in? So the way you get those in is you go to your tools and you go to your debtors and your creditors, and very simply you just add those in. So you can see here each year we've been adding them. Right, it's very easy. You just put in your, this is just and it actually, let's have a look here. Trade debtors, you can see the GST on there, right? You can see the GST, this is the exclusive of GST, but the way we're putting it in, we're just dropping it in. We should just be able to put it straight in. Let me just see if I can show you. Add a balance. So let's just add a balance for 30 June 25. So let's say that the outstanding amount is 110,000, then you probably have 10,000 in tax. This is debtors 25. Right? So it's going to show as 110, but when it comes to the, and let's put in the creditors as well. We'll do that as 55 for 25. Now, when we go and generate that report, you got to just choose the month there, right? Now you can see that, yes, this is what's on the activity statement, 28 and 20, but this is what we'd hope to find on the ledger, 38 and 25. So it's because it's picking up the 10 and the 5 there, right? So that pretty much explains the last set of the tools there. And then there's one final aspect to this, which is the true balance validator. Now, the true balance validator is a little bit difficult to explain, and I don't know if I'm able to validate because there's no transactions. Okay, so I think the one that we did have that had something like this was, what was they? What were they called? They were called Damel. I believe that this entity had this scenario at one point in time, and I think it was, let's just have a look. So this tool here, the True Balance Validator, interacts with the activity statement integrated account. And you can see here, we've got our so this is where, of course, I've imported my transactions. You can import your transactions. Okay, this client is actually, they've closed their business, but typically you can import your integrated account and your tax account transactions. I showed you that earlier. And then what you have is you have a situation where if at a certain point in time an amendment is done in a prior year, that amount has to be accounted for in the running balance. And I don't know where I'm going to find it actually, because it goes so far back, and maybe I don't even have it in this data set. It looks like it might have been overwritten. But the way to learn about that, let me just go to the Logit website. And what we have here is reconciliation tools. So everything that I've been showing you today is pretty much available here. So now importing the integrated account and tax accounts is probably, the video's changed because previously you had to import from the ATO via the CSV, and now you can see you can press the buttons in Logit and it'll bring in your integrated and tax account for analysis in Logit. But the True Balance Validator is this one here. It allows you to easily discover the correct liability balance for the ATO integrated account on the balance sheet if there's been amendments to pre-June activity statements. So this one here, I will just share the link with you because I cannot find the actual demo in my own system. So the only way you're going to really understand this is if you have a look at the video. So check that out. But other than that, I think what we've done is pretty much go through everything here. The only thing I would say is that, let's just have a look again at Desert Run, because I want to show you one more thing here, and that is if you are using these tools for analysis, the activity statement GST Analyser, one thing you want to notice in here is that the totals down here are conditional on clicking. So you can actually see the comparison. So this is the 205, 180. That's the comparison of the January to March quarter, because it's comparing it with the 205, 540 there. You see 205, 540 versus 205, 541. So it's actually comparing quarter on quarter. So if you're looking for your actual quarters, you just click the quarter or the month.
Just so that you can figure out which quarter it is off.
Yeah, exactly. Because you don't know which quarter's got the issue in it just by looking at the total, right? Now look, under $5,000, technically you can just amend it in the final June quarter. It's often just easiest to open the June quarter, do your amendment, everything's square. Because the goal is to get this square. Now, some people might not even bother over $300 to make it square. But, if you've got 10 grand difference or whatever, you've probably got a problem. You need to fix it. That's why this is quite a useful tool. Anything else in here that I could think of that should be known about? Probably not. I think we've pretty much covered the work papers and the depreciation in some detail. Yeah. Now, what I missed in that demo was to show how the work papers work. Now, as you saw, we did carry out the import of the accounts, and I'll do that just once more. Copy over the top. I'm using this template. I filled the template, and here it is. Of course, you can import your accounts from any system, but for the demo, I'm just using Excel. So whatever line items are in here will present in the workpaper layer when you create a workpaper layer for that year. I'll add myself as the accountant and the reviewer. Now you've got yourself a draft set. And you can certainly come along in here and attach your reference documents. So either from the library or the upload. The library is the file store, so you can have someone, before you even start working on the work papers, attach the reference documents in the library. And here I haven't got any, but we'll certainly upload a document. So why don't we just go to, I'll just, for this example, just upload. It's just going to be a bank statement. So pretend that's a bank statement. You look on the bank statement and hopefully that's the balance. And then you can put a tick there. You obviously don't have to put a work paper against every line item, just whichever line items from the perspective of your firm makes sense, where you've got protocols for adding work papers, probably all the hire purchases, the company tax liability, the old bank account, which is obviously a bank overdraft, and so on. Now, when you as the accountant have finished, you can come in here and you can click complete. The status of these work papers will now be sitting as completed there, and in the work tab they show as on review. Also, that will repeat in the work tab on the primary work tab, so they will be on review here, and in the work papers they will be completed. You can open from any of these areas and then continue your work. If you do need to make further changes, then if you do come into these work papers, simply we need to take them back to an uncompleted state. So we need to take them to a completed state and then unlock them. And then now they're back to scratch, they're drafting again, right? So they'll be sitting in drafting. You can make whatever changes you need. So now it may be the case that you want to integrate depreciation from the depreciation schedules. This is the only case where we've actually done this so far. So this is using the depreciation module I already showed you previously in the demo. And you can see here what it's dragging in. It's dragging in the values out of the accounts to map against the expected values, which are coming into the worksheet. Now, if the worksheet doesn't show, just reload. There's a bit of a quirk there. And you've got your worksheet. So here you can see the expected value is 40,000, the cost. And the closing written down value here is 17, whereas it's in the ledger, it's 37, 75 minus 38. These are the ledger values. So in this case, of course, there's a situation where this doesn't balance. And of course, you're going to have to go and do the investigation. Maybe our worksheet is wrong, or maybe the ledger is wrong. When it comes to selling, we have increasing and decreasing adjustment on disposal of assets. You can map the line items for the increasing or decreasing, which would be your profit or loss. And you can see here, if it is a profit account, then it'll be in the revenue area. You'll map it from the revenue area. If it's a loss, it'll be in the expenses section. And then you'll be able to select and reference to the profit or loss. So that is pretty much the work papers. There's not a lot more to them.